Okay, meantime, the members will be going on joining as the clock has struck 4 already. We shall start the seminar for today. I welcome all the members, past chairmen, my committee colleagues, and the senior members of the profession for the second day of the Andhra Pradesh State Sub-Regional Conference. Today we have two topics on GST. Everybody, this GST from the day it was been incepted, many controversial issues are there, mainly in regard to the section 16.2 of subsection C and the 16.4 and 36.4. That's the reason we have selected this, because the main crux of the GST is the input tax credit, because the benefit which will be received by the client or our customer. So how to avail it? What are the criticalities in it? So I definitely think that Sir will enlighten our members. All the members who has attended this program will enlighten themselves and do best to their services to the clients as well. I request Prashant, Treasurer, to take over the further proceedings. Thank you, sir. I welcome you again to Vishal virtual mode, sir.
Thank you, ma'am.
Good evening to all. CA Arpit Haldia is from Jodhpur. He has work experience more than 15 years. He is presently partner in Messrs. Paritosh Gupta and Co. Chartered Accountants from 2002 till date. He is a commerce graduate from Jai Narayan Vyas University. He qualified Chartered Accountant in the year 2002. He did his DSA in 2003. He completed his company secretaryship in 2004. He completed law degree in 2005. He did his doctorate PhD in 2006 from Jai Narayan Vyas University. He did his diploma in insurance and risk management in 2006, and he completed his ICWA in the year 2007. He is in practice since 2002 and handling areas like direct taxes and indirect taxes, GST and audit assignments. He has been awarded PhD in comparative study of existing system of sales tax and proposed system of value added tax. He has authored the books on GST, that is GST Made Easy, GST Mini, Ready Written Out, GST Search and Season in English, and GST Samasya Evam Samadhan and GST E-Waivers in Hindi, which have been published by the Taxman Publications. His articles on VAT, GST and direct tax has been published on various websites, including Taxman, and have been published in local journals and newspapers. His articles published, and he is a speaker in different seminar, conferences and study circle meetings during the last 3 years. He also has been a regular speaker in 2007 in seminars, conferences, study circle meetings organized by the various committees of ICAI branches of the Institute of Chartered Accountants of India and trade and professional bodies. His articles have been published on GST, VAT and direct tax, and have on his own website. He has in www.gstonline.com. He is also visiting faculty for NASIN for training of CGST officials and for Deloitte Touchy LLP for training SGSD officials at Rajasthan. He did PhD on comparative study in existing systems of sales tax and proposed systems of value-added taxes, and he also worked as a member in district level GST committee Jodhpur, formed in pursuance of order of sales tax of Rajasthan. He is a secretary for Tax Bar Association Jodhpur in the year 2009 to 11. He is secretary of Jodhpur branch of CARC of ICAI for the term 2012 to 13. He is a treasurer of Jodhpur branch of CARC of ICAI for the period 2011 to 12. He is a Sikasa chairman, Jodhpur branch of CRC of ICAI from the term 2010 to 11. He is a regular blogger on the GST, and in the last 5 years, he has written about 700 blogs on the GST on personal website also www.gstonline.com. With these few lines, I'm happy to introduce CA Arpit Haldia to the August gathering. Thank you very much. I'm handovering the proceedings to the chairperson.
A small virtual welcome, sir, to you.
Thank you. It was a very nice surprise.
We are unable to give you a handbook physically, so only we are giving you.
But it was a very nice surprise.
So you may go ahead with your proceedings, sir. Yes, sir, we could see your screen.
First of all, I would like to thank Visakhapatnam branch for inviting me and giving me the opportunity to share my thoughts on the three most burning issues in GST, if I can say 16.4, 16.2C and Rule 36.4. And would like to congratulate at the outset for the organizing the sub-regional conference of ICA members, and privileged to be a part of the sub-regional conference as a speaker. And thank you very much for a detailed, very detailed. I only shared it and thought that only brief would be spoken, but thank you very much for a very detailed introduction. And starting with my today's topic, that is input tax credit, section 16.2C, section 16.4 and rule 36.4. See, the first part which comes to our mind is whether ITC is my vested right. We very casually say that ITC is my vested right. How one can deny me that right? I have earned it. So before moving on to section 16.4 or section 16.2C or rule 36.4, which all circulate around the issue, let's start with the very basic issue, Article 300 capital A or Constitution of India, which says that no person shall be deprived of his property save by the authority of law. So the two critical aspects in this Article 300 capital A is that a person would not be deprived of his property. So the first thing is that which Article 300 capital A says that it should have become the property of that person, and it cannot be deprived by unless by the authority of the law. So there should be a law which specifically provides that he can be deprived of that property. So when I say that ITC is my vested right, so a vested right comes to me when something has accrued to me. Anything which has not accrued to me, which is far away from me and it is an expected benefit from me, that is not a vested right. And secondly, there should be the authority of law which can deprive me of that property. Once these two conditions have fulfilled, then Article 300 capital A says that a person can be deprived of his property. But unless these two conditions are not fulfilled, then Article 300 capital A specifically restricts the taking away the vested right of a person. So starting with Article 300 capital A, and since it uses the term property, so when ITC or what is meant by the term vested right, I have tried to collate certain landmark judgments of Honorable Apex Court regarding what is meant by vested right. If we go through the first of the judgment, that Gangs Rope Company Limited and others, it says the word vest is normally used where an immediate fixed right in present or future enjoyment in respect of property is created. So the important aspect is when the right is created, then the thing vests in me. If I go through another judgment of J.S. Yadav versus State of UP, it says the vested right is a right independent of any contingency. Such a right can arise from a contract, statute, or by operation of law. So again, There should be no contingency regarding the right which is accruing to me. Such a right should arise from the contract, statute, or by operation of law. Another important judgment of Hungerford Investment Trust versus Haridas Mundra and others, it says the mere right to take advantage of provisions of an act is not accrued right. So there is a provision of which I can take advantage, but unless until I have complied with all the conditions, it does not accrue to me. So for a vested right, it has to accrue to me. Mere expectancy of a benefit to me is not a vested right. So when a statute puts certain conditions, that these conditions have to be fulfilled, and once those conditions have been fulfilled, only then I can validly say that it has become my vested right. And once it has become my vested right, then nobody can deprive me of that right unless there is a specific provision in the law, and that provision of law should also meet the test of equality, reasonableness as provided under Article 14 and Article 16 of the Constitution of India. As has been held by Honorable Apex Court, we would again refer the judgment of J.S. Yadav versus State of UP, wherein Honorable Apex Court observed that in Union of India and other versus Tushar Ranjan Mohanty, this court declared that amendment with retrospective operation as ultra vires, as it takes away the vested right of the petitioners therein, and thus was unreasonable, arbitrary, and violative of Article 14 and 16 of the Constitution. So let's put a hierarchy. There is a provision of which I can take an advantage subject to fulfillment of certain conditions. Once I fulfill those conditions, that expected right becomes my vested right. Once it becomes a vested right, it cannot be taken away from me unless by the authority of the law, and that authority of the law should satisfy the test of reasonableness and equality as provided in the Article 14 and Article 16 of the Constitution. So this is a brief discussion on what is a vested right. Going forward in this discussion, we would discuss that when ITC becomes a vested right and when the law cannot deprive me of that right. There are, if somebody asks me, there are 4 landmark judgments of Honorable Apex Court in this issue. And there are 2 other judgments of Honorable Apex Court which we commonly discuss during our discussion and say that on the basis of those 2 discussions that ITC is my vested right. Let's try to discuss those 6 landmark judgments of Honorable Apex Court and try to identify that whether ITC is a right or a concession, and secondly, when ITC, which is a concession, becomes a vested right. So first decision is in the case of Godrej and Boyes Manufacturing Company Private Limited. This was a decision of 1992 when Honorable Apex Court specifically observed that we fail to understand how a valid grievance can be made in respect of such deduction when the very extension of benefit of set-off is itself a boon or a concession. So a certain percentage of deduction was made from the ITC under by way of an act which was the subject matter of this case, and the appellant went before the Honorable Apex Court and said that this deduction should not be made since ITC is my vested right, and therefore Honorable Apex Court specifically negating the contention of the applicant said that a grievance cannot be raised regarding the deduction from input tax credit when the very extension of benefit of set-off is itself a boon or a concession. Going forward, there are the next 3 judgments are the judgment which have been given very recently. One in 2016, next is 2017, and third is 2018. In 2016, in case of Jayam and Company, it was said that it is a very right law that whenever concession is given by statute or a notification, etc., the conditions thereof are to be strictly complied with in order to avail such concession. Thus, it is not the right of the dealers to get the benefit of ITC, but it is a concession granted by virtue of Section 16. Again, very categorically said by Honorable Apex Court that unless until you fulfill the conditions, it is only a concession granted by the statute, and once you fulfill those conditions, then only it becomes a vested right. Again, in case of, I am going verbatim by the judgment, because these judgments laid on a very clear law which has to be in our mind while advising our clients that whether ITC is a vested right or a concession. In case of MK Agrotech Private Limited, 16 SEC 210, again Honorable Apex Court, wherein they observe, keeping in view this objective, the legislature intended to give tax credit to some extent. However, how much tax credit is to be given and under what circumstances is the domain of the legislature, and the courts are not to tinker with the same. Again, how much tax credit is to be given, under what circumstances is to be given, by the term what circumstances, it includes the condition which have been laid down in the law. These are the domain of the legislature, and courts would not enter into that domain. Again, in case of ALD Automotive 2018, another landmark judgment and the most recent one, the input credit is in the nature of benefit of concession extended to dealer under the statutory scheme. The concession can be received by the beneficiary only as per the scheme of the statute. Very clearly, it is there that it is a concession. It would only be a vested right only when I fulfill the conditions as laid down in the law. So these are the 4 decisions, and now coming to the 2 decisions. One is the Eicher Motors and second is the Daiichi Kakaria, which are very commonly referred holding that ITC is a vested right. But if we go into the detail and read through the judgment, there are 2 significant observations in those judgments. In case of Eicher Motors Limited versus Union of India, it was said that the assessee became entitled to take the credit of the input instantaneously once the input is received in the factory on the basis of existing scheme. So therefore, the existing scheme provided that the assessee would become entitled when they receive the input. So once the input has been received, the entitlement is there to take the credit. So when in case of Eicher Motors, Honorable Apex Court said that IT is a vested right, they said because the scheme at that time provided that if the goods are received, it would become, the assessee would become entitled to take the credit. Again, in case of Daiichi Kakaria, it is clear from these rules as we read them that the manufacturer obtains credit for the excise duty paid on raw material to be used by him in the production of an excisable product. Immediately it makes a requisite declaration and obtains an acknowledgement thereof. So in case of Daiichi Kakaria, what they said that the assessee would become entitled to the credit when he makes a requisite declaration and obtains an acknowledgement thereof. So somewhere down the line, is it not equal to the conditions which have been provided under section 16 subsection 2 and section 16 subsection 4, that you have to fulfill the 4 conditions which have been provided? 16.2a, valid document; 16.2b, receipt of goods; 16.2c, payment of tax; 16.2d, filing of return; and 16.4 is the time limit within which the ITC has to be taken. See, again, I am not commenting upon the constitutional validity of the individual provisions which we will be discussing, but I am only saying that if I am at a compliance stage, the first thing which I should keep in mind that ITC is a benefit or a concession given by the statute. Secondly, it becomes a vested right when I fulfill the conditions as provided under the law. Third, once I have validly claimed that right or I am entitled to that right, then nobody can deprive me of that right unless by the authority of the law. And fourth, the authority of the law which is depriving me should not be unreasonable, should not be unequitable, and should satisfy the test of Article 14 and 16. So till now, one thing in my opinion, as for my understanding, should be clear that we have to follow conditions as provided in the section 16.2 and 16.4. To what extent, that we will be discussing in the coming slides. So this was a brief discussion upon the issue that whether ITC is my vested right, and till now, as for my understanding, I have tried to clear that issue, that how ITC becomes a vested right. Now, before going on to section 16.2c, 16.4 and rule 36.4, I would like to discuss one principle of law which says that lex not cogit impossibile, that is, law does not compel a man to do that which he cannot possibly perform. In simple words, law cannot ask me to do anything which is impossible for me to perform. And this is one important thing which is very distinctly quoted or very rarely quoted when the discussion is made upon section 16.2c. So before going on to 16.2c, let's try to discuss this important aspect of law, and then we would move on section 16.2c. That law does not compel a man to do that which he cannot possibly perform. These are some landmark cases on this issue. First, discuss the decision of Bombay High Court. In this, what happened is a person sold his capital asset. He accrued some capital gain, and on for saving tax on that capital gain, he had to invest certain amount in section 54 EC. At that time, only two companies were there who were entitled to issue bonds under section 54 EC. And within the time limit of 6 months from the sale of capital asset, there were no bonds of these two companies which were issued during the period of those 6 months. So assessee went before the Honorable Bombay High Court and said that since I have sold the property and from that date till the next 6 months there have been no bonds issued by these two companies, how I can save my capital gain? So Honorable Bombay High Court, by referring to this principle, said the statute with section 54C of the Act provides for exemption from tax to long-term capital gain, provided the same is invested in bonds of Rural Electrification Corporation or NHAI. However, as the bonds were not available, it was impossible for the respondent assessee to invest in them within 6 months of the sale of their factory building. And by referring to this theorem, that is lex not cogit impossibila, and law does not expect a party to do the impossible, they extended the time limit for compliance of section 54 EC. Honorable Allahabad High Court, in case of the Inter-College versus State of UP, made a very significant observation that the law does not compel a man to do that which he cannot possibly perform. The other similarly recognized legal maxim are where the law creates a duty and the party is disabled to perform it without any default in him and has no remedy over there, the law will excuse him. Very important, where the law creates a duty and the party is disabled to perform it without any default in him and has no remedy over there, the law will excuse him. I would not go through all the decisions. This would be shared across in the presentation. And last but not the least, in case Honorable Apex Court, in case of presidential poll versus unknown, the law does not compel one to do which he cannot possibly perform. Therefore, when it appears that a performance of the formalities prescribed by a statute has been rendered impossible by circumstances over which the persons interested had no control, the circumstances will be taken as a valid excuse. So, if the performance of the formalities as provided in the statute becomes impossible due to circumstances which are beyond the control of the person who was liable to do those duties, that is a very valid excuse. Now, with this background, let's try to move ahead in section 16.2c. What it says is, notwithstanding anything contained in this section, no registered person shall be entitled to the credit of any input tax in respect of any supply of goods or services of board to him unless, subject to provision of section 41 or section 43A, the tax charged in respect of such supply has been actually paid to the government. So this is the first condition, that a person would be entitled to input tax credit only when the supplier has paid the tax to the government. This was something which was a bone of contention from the VAT regime. That if a seller has not deposited the tax, how can a buyer be expected to ensure that he goes and deposits the tax and then only the buyer would be eligible to claim the credit? So the first condition which has been provided in section 16.2 is that the tax should have been paid to the government. Second, This was the limit which was set by the VAT Act. But GST Act goes one step ahead. And how it goes one step ahead? That the tax should have been actually paid to the government either in cash or through utilization of input tax credit admissible in respect of the said supply. So not only the buyer has to ensure that the tax has been paid to the government, he has also to ensure that the seller has deposited the tax through utilization of ITC admissible in respect of the said supply. Now there are two impossible things here. First, ensuring that the seller should have deposited tax, and second, he should have deposited tax through admissible ITC. Now, if I go back to that theorem which we have discussed, let's not cogit impossibila. Law does not compel a man to do that which he cannot possibly perform. So, what are the rights available to me in the law to ensure that he has deposited the tax? Whether it is not an impossible condition being put on the buyer that he has to perform that duty. Whether it is not impossible for a buyer to ensure that the seller has utilized admissible ITC, whether the buyer has the rights to go and check the books of accounts of the seller. When the officers who have been vested with all the powers in the act are not able to ensure that seller has deposited tax, how a buyer can ensure that thing? And when a buyer cannot ensure that thing because it is impossible for him, the act, the condition which has been put in the law is clearly hit by this principle of law, that I cannot be compelled to do the impossible thing which is not in my hand. So now the question comes that whether this principle which we are discussing has been referred to in any of the cases under the VAT Act, because GST is a new law, whether this principle has been referred in any of the VAT Acts wherein similar issue arise before them. So yes, this principle has been validly referred to in two of the judgments which I have referred here. First is the judgment which we have commonly come across, that is Arise India Limited, wherein Honorable Apex Court referred. Therefore, there was need to restrict the denial of ITC only to the selling dealers who had failed to deposit the tax collected by them and not punish bona fide purchasing dealer. The latter cannot be expected to do the impossible. Again, the same thing. The buyer cannot be expected to do the impossible. In the event that selling dealer fails to deposit the tax collected by him from the purchasing dealer, the remedy for the department would be to proceed against the selling dealer for recovery of such tax. So if the law is asking a bona fide purchaser to ensure that the seller has deposited a tax, it is asking the buyer to do the impossible. We commonly discuss it in our day-to-day practice that this is an impossible thing. But we very rarely refer the actual principle of the law which provides that law cannot compel a man to do anything which is impossible to perform. Second judgment, RS Infra Transmission versus State of Rajasthan High Court, wherein Honorable Rajasthan High Court specifically referred, we are in complete agreement that it will be impossible for the petitioner to prove that the selling dealer has paid tax or not, as while making the payment, the invoice including tax paid or not, he has to prove the same, and the petitioner has already put a summary on record which clearly established the amount which has been paid to the selling dealer, including the purchase amount as well as tax amount. So again, Honorable Rajasthan High Court provided that it would be impossible for the buyer to ensure that the selling dealer has paid the tax. I have referred these two judgments because the provisions in these two acts were somewhere similar to the provisions in GST Act. That tax should have been paid to the exchequer for the buyer to be validly entitled to claim the credit. But again, as we have discussed in the previous slide and these two landmark judgments, that it is an impossible task for the buyer. And whenever a query is raised by the department, the method in which we should reply is that first we should submit all the relevant documents which are available with us, which prove that actually the goods have been received. And secondly, I have satisfied the conditions as laid down in the law except section 16(2)(c). So I should submit the invoice copy. I should submit the mode of payment if made by bank, then the bank statement. I should submit the copy of e-way bill, that e-way bill has been generated. Fourth, I should submit the copy of the bill of lading if the goods have been transported through truck, or if there is no BL, then the agreement with the transport operator, or any proof that this was the transporter who transported the goods to my premises, and if possible, the toll receipts which are available with the transporter, which proves that the goods have been received by me. And once I am able to provide all those documents, I am able to provide my bona fide, then expecting me to ensure that the seller has deposited the tax is an impossible condition, which I should clearly provide in my submission, that this impossible condition cannot be satisfied by me because I am a bona fide purchaser. Second aspect which we should ensure is that at present there is no mechanism on GST portal which provides a buyer to raise his grievance that the seller has not deposited the tax. And I just have gone somewhere on Twitter, there was a news a month back that government is soon bringing a mechanism on GST portal wherein a buyer would be able to communicate with the seller and ask him to deposit the tax if he is not able to view the entries in GST or 2A. But it has not been brought on portal. Until that facility comes, what we should do, and we do in some of our matters, is lodge the grievance or the concern that the buyer has not deposited tax on the Prime Minister grievance portal. Once I have lodged my grievance, I am devoid of all my responsibility because I have informed that the seller has not deposited tax, and department should take steps against the seller to recover the due taxes. This is the best which can be expected from the buyer. Going beyond this would be expecting to do the impossible. And if we are able to satisfy these two things, then in my opinion, the law as it is a developing law, going forward, we can expect that the decisions in GST regime for allowing credit to bona fide purchasers would be coming on the same line which have been coming lately in case of VAT regime. But I have to prove my bona fide. If I am able to prove my bona fide, then in addition to that, it would be a good thing if I can raise a complaint against the seller that he has not deposited the tax. This would only further strengthen the genuine claim of the buyer to claim the ITC. So with this section 16(2)(c), we have discussed how to reply and what are the documents which have to be submitted and what additional information which we can submit, because once we raise a grievance on Prime Minister grievance portal, it goes directly to the assessing officer of that person and he has to ensure that compliance. Once he has ensured that compliance, there would be little doubt that the tax would be recovered from the seller. And even if the tax is not recovered, I have done the best which I could have done. And going beyond that is something expecting me to do the impossible. So this was section 16(2)(c). Now coming to the press release, which was released on 18th October 2018. Now this we are discussing the scenario of the credit availed up to 9th October 2019 until Rule 36(4) was made operational. We would be discussing Rule 36(4), but prior to Rule 36(4), there was only section 16(2)(c). And this was a press release which provided that it is clarified that furnishing of outwards details in GSTR1 by corresponding supply and the facility to view the same in GSTR2A by recipient is in the nature of taxpayer facilitation and does not impact the ability to the taxpayer to avail ITC on self-assessment basis in consonance with the provisions of section 16 of the Act. So again, this press release provided that reflection of entry in GSTR 2A is only for the facilitation of the taxpayer. It does not impact the ability of the taxpayer to avail ITC. So prior to 9th October 2019, whether an entry reflects in GSTR 2A or not, it is having no legal backing. Whether it is having a legal backing after 9th October 2019, that this we would be discussing while discussing Rule 36(4). But prior to 9th October 2019, GSTR 2A is whether the entry reflects in 2A or not, it is having no legal backing. So there are these are some situations which I have tried to formulate to conclude the matter in the best possible way. There are 4 situations. First, what if my supplier has filed GSTR1, so therefore it is reflecting in my GSTR2A, and has not filed 3B and I have tax invoice. So in this case, he has filed his GSTR1 but has not filed GSTR3B and I have valid tax invoice. So by not filing GSTR3B, he has not complied with section 16(2)(c). So again, the same discussion which we had previously. What is my duty in such case? I should have a valid invoice. I should have an e-way bill. I should have a proof of transport. I should have the mode of payment. I should have the proof of payment. And if possible, I should raise the complaints against the seller. This is the best I can do. And even if the assessing officer denies me the credit, I should be able to take that matter into litigation. Second, what if I have tax invoice and my supplier has filed 3B but has not reflected my GSTI and GSTR1? So in this case, I have the tax invoice. Supplier has filed GSTR 3B, that is compliance of section 16(2)(c) has been made, and he has not reflected my GSTI and GSTR1. So therefore, now the entry is not reflecting in GSTR 2A. Now in this case, since compliance of section 16(2)(c) has been made, what I can do is obtain a declaration from my supplier on the ledger account that these invoices have been reflected in GSTR 3B and tax in respect of those invoices has been paid, and due to error, these invoices were reflected in B2C rather than B2B column. And even if the department denies credit because that it is not reflecting in GSTR 2A, then I can say that reflection of entry in GSTR 2A was merely a facilitation process. It was not having legal backing. Now third case, what if I have tax invoice but my supplier neither filed GSTR 3B nor filed GSTR 1? Again, the same scenario as situation 1. I have a valid tax invoice, I have the payment proof, I have the e-way bill, I have the transport proof, and if possible, I have lodged the claim against the defaulting seller. This is the best which I can do. But there's one word of caution in all these situations, that I should have a valid tax invoice. As per section 16(2)(a, a valid tax invoice is as per the provisions contained in Rule 36. And Rule 36 sub-rule 2 provision provides that there are 5 elements which have to be mandatorily provided by the seller on the invoice relating to the buyer. And out of those 5 mandatory things, one is the GSTIN of the recipient. And if GSTIN of the recipient is not there, then the recipient cannot say that it is the valid document. So we should educate our client that whenever goods or services are being goods are being purchased or services are being availed, it should be ensured that your GSTIN is on the invoice for the purpose of claim of credit. Because if my GSTN is not there, then how the seller would show it in his GSTR1? And that would be non-compliant if I'm not, if I, as a recipient, I am having invoice on which my GSTN is not mentioned. Then as per rule 36, read with section 16(2)(a), it is not a valid document for the purpose of claim of credit. So as an auditor, in my opinion, when we are doing compliance of GSTR 9C, this is one important thing which has to be seen while verifying the credit on the invoices which have been claimed by the recipient. Fourth, mismatch in ITC claimed and reflected in GSTR 2A due to error of supplier. Now again, I have the invoice which is showing a tax of say 1000 rupees. But my supplier has uploaded a document which is showing ITC of 800 rupees. Again, this is the error of supplier for which the recipient cannot be made to suffer the burden. And if all the conditions as we have discussed, the invoice, the proof of payment, the proof of transport, the e-way bill are there, then department cannot deny me the credit. If they are denying, we can very well go into litigation and argue our cases. So this was the situation prior to 9th October 2019, when as per law and as per the press release, GSTR 2A was only a facilitation measure. Now coming to Rule 36(4), which was inserted on 9th October 2019. First, it provided a capping of 120, capping on ITC availed of 120% of the amount, 120% of the amount reflecting in GSTR 2A, and then from 1st January 2020, it restricted the credit to only 110% of the amount reflected in GSTR 2A. Now there are two aspects to it. First is the literal aspect of Rule 36(4). And second is the constitutional aspect of Rule 36(4). I would not be going into much detail of the literal aspect of Rule 36(4) because it has been discussed at many times, but there is one issue which I would like to discuss and then move on to the constitutional aspect or the validity aspect or how Rule 36(4) cases has to be argued. If we see Rule 36(4) says input tax credit to be availed by a registered person in respect of invoices or debit notes, the details of which have not been uploaded by the supplier under subsection 1 of section 37 shall not exceed 10% of the eligible credit available in respect of the invoice or debit note, the details of which have been uploaded by the supplier under subsection 37(1). So presently, as per the circular which was issued on 11th November 2019, there was para number 3 in that circular which provided that a recipient can claim credit only of the invoices which are reflecting on after the due date of filing of GSTR 1. So for example, for October 20, the last date for filing of GSTR 1 was say 11th November 2020. So whatever invoices which are reflecting in GSTR 2A as on 11th November 2020, a recipient can only claim credit in respect of those invoices, and subsequently GSTR 2B a form was notified, and this form is also generating on the basis of GSTR 1 filed till 11th of November 2020. Now the circular puts a restriction that even if supposedly I have filed my return on say 20th November 2020, and some of the suppliers for month of October have filed their GSTR 1 between 12th of November 2020 to 20th November 2020. But the circular says that even if they have filed the return between that period, you are only eligible to claim credit up to the GSTR 1 filed up to 11th of November 2020. If I go through Rule 36.4, there is no such condition coming from Rule 36.4. Only condition which is coming from Rule 36.4 is that the credit should only be availed in respect of invoices which have been uploaded by the supplier in the statement as per section 37.1. It does not say that the credit should be availed only in respect of invoices which have been uploaded by the supplier up to the due date of filing of GSTR1. So this is one condition being put by that circular, which is going beyond the literal interpretation of Rule 36.4. Leave aside the validity aspect of Rule 36.4. So if the circular says that I am only eligible to claim credit of invoices filed up to 11 November 2020, in my opinion, it is going beyond the provisions of the rule. I am eligible to claim credit which are reflecting as on the date I am filing return. So if I am filing return for October 20 on 20th November 2020, I am eligible to claim credit of invoices which have been which are reflecting in my 2A, even if GSTR1 has been filed after 11th November 2020. So this is one aspect. Second aspect, it says input tax credit to be availed by a registered person. Now, what is meant by the term availed? See, this aspect would be having a very vital impact on the analysis of Rule 36.4. Rule 36.4 uses the term availed. And if we go through the entire scheme of the Act and Section 39.1, Section 39.1 says that while filing return under Section 39.1, a person has to give detail of the input tax credit availed, which would mean that ITC which is being reflected in GSTR 3B is the ITC availed by the registered person. So Rule 36.4, when it uses the term avail, it refers to 3B it refers to the relevant GSTR 3B through which the ITC is being posted to electronic credit ledger. So whenever I am filing GSTR 3B, whatever credit I am showing in that GSTR 3B, I am availing that credit. And when Rule 36.4 says that ITC to be availed by a registered person in respect of invoices or debit notes, so therefore, whatever return I have filed for whatever period after 9th October 2019 through which I am availing ITC, they are hit by Rule 36.4. There is a common interpretation that Rule 36.4 is only applicable for returns from the period October 2019. This is a wrong interpretation in my opinion. When Rule 36.4 says that ITC to be availed should be 110% of the ITC being reflected in GSTR 2A. So if I am filing return for March 2019 after 9th October 2019, I am availing the credit. And that availment as per the intention of the legislature has to be through as per Rule 36.4. So the interpretation that Rule 36.4 is only applicable for returns filed for the period October 2019 onwards is, in my opinion, incorrect interpretation. Rule 36.4 is applicable for any ITC for any period which has been availed after 9th October 2019 through filing of GSTR 3B. So if I file return for March 2019 after 9th October 2019, I am availing credit. So in the opinion of legislature, that availment should be in line with the provisions of Rule 36.4. So these were two aspects which I thought would be relevant to discuss. First, the availment part, that the provision of Rule 36.4 are not only applicable for returns for the month of October 2019 onwards, but it is applicable for any ITC which is availed through GSTR 3B after 9th October 2019, irrespective of the fact to the period, irrespective of the period to which the return relates. And secondly, the contention of the legislature of the department through issuance of circular that the credit would be available only in respect of invoices which have been uploaded up to the due date of filing of GSTR 1, and that's why they are generating GSTR 2B on 12th of every month is an incorrect proposition. Rule 36 will only say that I am eligible to claim credit of GSTR of the invoices which are reflecting in GSTR 1, and in my opinion, which are reflecting as on the date of filing of return for that period. Now coming to the constitutional aspects or how the matters relating to Rule 36(4) have to be dealt with. See, before going into Rule 36(4), what I believe is that most of us are at the compliance stage. There are two aspects. One is the compliance stage and second is the litigative stage. So when we are at the compliance stage, in my opinion, there are only two approaches. Either follow the law or challenge the law. Or is invalid, then in my opinion, we should challenge that part. Because once a non-compliance is detected by the department, then there are all the provisions that the penalty would be levied, there would be other anti-evasion measures. But if we are able to challenge the law, because we firmly believe that it is not the correct law, then even if the decision comes against us, we would not be liable to penalty. However, this is an issue how many people would be able to challenge the law. So in that case, if they are not able to challenge the law, then in my opinion, they should follow the law, because if the non-compliance is detected by the department, it would be very, very costly affair for them. Because then they would be burdened with all the non-compliance or anti-evasion measures. This is again my personal opinion. Either follow the law, challenge the law. However, each and every individual is free to take their own call. So while deciding whether how Rule 36(4) is valid or not, so prior to going into the nitty-gritty of validity of Rule 36(4), one thing is pretty clear, that whatever contentions we have discussed in section 16(2)(c), that I have all the valid documents, I have lodged a complaint, and beyond that, it is expecting me to do the impossible. These are all applicable to Rule 36(4). And in addition to that, what are the additional contentions which can be made by us? These are being discussed here. So if we go through 16(2)(c), 16(2)(c) provided that subject to the provision of section 41 or section 43A. This section 43A was to be inserted in CGST Act, which provided that the procedure for availing input tax credit in respect of outward supplies not furnished under subsection 3 shall be such as may be prescribed, and such procedure may include the maximum amount of input tax credit which can be so availed not exceeding 20% of the ITC available on the basis of details furnished by supplier under the said subsection. So this 43A(4) specifically empowered the government or empowered the department to bring in the capping on the ITC to be availed. But as on date, as the things stand, this section has not been notified till date. So if this section has not been notified till date, the first question is, what is the relevant provision which is empowering Rule 36(4)? Because when we go through the scheme of legislation, first there is an enabling section under the statute, and on the basis of that enabling statute, then there is a delegated legislation in the rules. So for any rule to be constitutionally valid, not to be intra vires, there has to be a parent or an enabling section. And as section 43 has not been notified till date, so the question arises, what is the enabling section for rule 36(4)? Whether it is section 16 subsection 1, which provides that a person would be registered person would be entitled to take credit subject to such restrictions or conditions as may be prescribed. In my opinion, section 16 subsection 1 cannot be that section, because had it been that section, then there was no requirement to bring in a condition bring for inserting section 43A in section 16(2)(c). Because section 16(2) is having an overriding impact both on section 16(1) and section 16 subsection 4. So therefore, in my opinion, section 16 subsection 1 does not have the legal backing to support the presence of rule 36(4), and in that case, the only section which is left is section 164. Which provides that the government is empowered to bring in the rules, bring in the necessary rules for proper enforcement of the provisions of the Act. Same section 164, which has come to the rescue for rule 117 for prescribing time limit under section 140, prescribing time limit under section 140 for the purpose of filing of Tran 1. So section 164 is one ground on the basis of which rule 36(4) can be said to be valid by the department, because it is having a very wide impact, and on that basis only rule 117 has been declared constitutionally valid by Honorable Madras High Court and Honorable Bombay High Court. So the doubt is here about the parent section or the enabling section for rule 36(4), whether it is section 16 subsection 1 or section 164. Writ petition against the validity of rule 36(4) have been filed before Honorable Rajasthan High Court, wherein the matter is yet to be decided. The notices have been issued to the department, but yes, we can very well challenge the constitutional validity of 36(4) in absence of section 43A. And even if there is a contention that 16(1) or 164 was there for 36(4), then the obvious question is, what was the necessity to bring section 43A then? So this would be the first ground to challenge the validity of section rule 36(4). Second, genuine inward supplies cannot deny benefit of ITC. This we have discussed. How recipient can be made responsible for supplier not depositing the due tax, again expecting the buyer to do the impossible. Mechanism available to the recipient as and when section 43 would have been applicable, not yet brought in place. So the mechanism which would have been brought in place when section 43A would have been made effective, the old, the Saral, the Sugam, the ANX 1, ANX 2, which enable the recipient to communicate or to raise the issue before the supplier, have not yet brought in place. So if the recipient does not have any power, if the recipient does not have any option, if the recipient does not have any remedy to raise his grievance, then how can a burdensome restriction be placed upon him? Next, section 16(2)(c), section 16(4) vis-a-vis rule 36(4). Now the question comes that section 16(2)(c) provides that no recipient would be entitled to credit unless the tax has been deposited. Rule 36(4) goes one step ahead, and it says that a person would be eligible to credit on the basis of GSTR 2A. And not only 2A, 110% of 2A. Now the question comes that if rule 36(4) is providing that I can claim credit on the basis of GSTR 1 filed by the supplier, and that too at the rate of 110%, whether it is not making a direct conflict with section 16(2)(c), which provide that ITC can only be claimed when the tax has been deposited, because entry reflecting in GSTR 2A is not a proof that tax has been deposited. So whether a piece of delegated legislation, that is Rule 36(4), can supersede legal conditions and authority behind delegated legislation yet to be identified. So had 43A been notified, and since 16(2)(c) was subject to 43A, that enhanced limit of 20% would have been legally valid. But since 43A has not been notified and Rule 36(4) is still searching for its enabling section, how can it allow a credit which is in direct contradiction to section 16(2)(c)? We are not discussing whether 16(2)(c) condition is valid or not. But even if it is held valid, then Rule 36(4) and 16(2)(c) are in direct contradiction. Supposedly, take an example that for 1920, my supplier has only deposited tax of say 1 lakh rupees. But Rule 36(4) allows me credit of 1,10,000 rupees. Now that difference of 10,000 of Rule 36(4) is in direct contradiction to 16(2)(c). And somewhere down the line, I do feel that department itself might challenge the validity of Rule 36(4) because it allows me additional 10% credit for which it is not required to be satisfied that whether tax has been deposited. Only merely reflection of entry in 2A, or secondly, 10% additional of the entries being reflected in 2A are sufficient for the purpose of claim of credit. So as we have seen at some point that the law is contradictory to itself at some of the places, this Rule 36(4) is in direct contradiction to section 16(2)(c). Because firstly, it allows credit merely on the basis of entries reflecting in 2A, irrespective whether tax has been deposited or not. And secondly, it allows additional 10%. And third, but last but not the least, section 16(2)(c) overrides anything contained in section 16. So it would override anything. If Rule 36(4) is based on section 16(1), then it would, or section 16(2)(c) would override 16(1) as well. So law is somewhere not very clear how Rule 36(4) fits into the scheme of the Act. In last, legal precedents laid down in VAT regime, the few judgments which we have discussed and other judgments as well, where we can quote that it is impossible for me, I am a bona fide purchaser and ITC cannot be denied to me. And the most important thing which we have discussed at the outset, that law cannot ask me to do the impossible. So this is all about Rule 36(4), how the compliance has to be seen, and if at all it has to be challenged, how we can go ahead and challenge Rule 36(4), and what are the key issues which are coming out of Rule 36(4) vis-a-vis section 16(2)(c). Now coming to the last topic for the day, that is section 16 subsection 4. This is one section which is creating a hue and cry between the registered persons, because GST was a new law, and for 1718 and 1819 there has been substantial, we cannot say non-compliance, but delay in compliances by the registered person on account of lack of clarity of the law. I would not say it's the same thing for 1920, and neither we are hearing any calls from people for extending the compliance date for 1920, but for 1819 and 1718, people are regularly making call to the government to extend the compliance date of section 16 subsection 4. So this, how does section 16 subsection 4 plays out? Very first thing, whether the government is empowered to put in a timeline for the purpose of claim of credit. This is one thing which we should be very clear of, that whether the government is empowered to put in a timeline for the purpose of claim of credit. Honorable Apex Court in case of ALD Automotive Private Limited versus the Commercial Tax Officer very clearly provided that the condition under which the concession and benefit is given is always to be strictly construed. In event it is accepted that there is no time limit for purpose of claiming of ITC as contained in 19 subsection 11 of TN VAT Act, the provision becomes too flexible and give rise to large number of difficulties, including difficulty in verification of the claim of ITC. We thus are of the view that time period as provided in section 1911 is mandatory. So Honorable Apex Court has very clearly provided that law legislature is empowered to put in a time limit for the purpose of claim of ITC. So therefore, if we are contending that a legislature cannot put in a time limit for the purpose of claim of credit, then in my opinion, we are somewhere directly in contradiction with the decision given by Honorable Apex Court in case of ALD Automotive Private Limited versus the Commercial Tax Officer. So this one aspect, in my opinion, has been very clearly dealt in by Honorable Apex Court. Now coming to section 16, subsection 4, which reads, a registered person shall not be entitled to claim, shall not be entitled to take input tax credit in respect of invoices or debit note. Now see, section 16 subsection 4 uses the term invoice or debit note. And if we go through rule 36, it refers that invoices as issued by the supplier. Second, invoices as issued by the recipient in compliance of section 31(3)(f) for RCM subject to payment of tax. And third, debit note or credit note issued under section 34. But in addition to that, there is also bill of entry for the purpose of import of goods. And for the purpose of claiming IGST on import of goods, the relevant document is not the invoice or debit note issued by the supplier. The relevant document is bill of entry. So in my opinion, when section 16 subsection 4 is only referring to invoice or debit note, it is not covering bill of entry filed at the time of import of goods. And even if ITC in respect of that bill of entry is claimed after the time limit provided in section 16 subsection 4, in my opinion, it is not hit by 16.4. The same parametry example can be seen in rule 36.4, which is covering invoices or debit notes. And the circular provides that that rule 36.4 is not impacting claim of credit for bill of entry in case of import of goods. However, 36.4 also refers to the reflecting in GSTI 1, but since the credit for import of goods is not through GSTI 1, but at the same time, when the legislature uses only invoice or debit note, and rule 36.1 provides that for the purpose of import of goods, bill of entry would be the relevant document. So in my opinion, 16.4 is not impacting a claim of ITC in case of import of goods. The second question, whether 16.4 impacts claim of ITC in case of RCM, that is goods or services on which I have paid tax under reverse charge method. See, the term has been used invoice, and if we go through rule 36.1, it clearly provides that for the purpose of claim of credit of the tax paid under RCM, self-generated invoice under 31(3)(f) subject to payment of tax is a mandatory document. So in my opinion, 16.4 impacts claim of credit for RCM. But what would be the relevant date? Whether it would be the date on which the invoice was issued, or rule 36(1)(b) provide that self-generated invoice as per 31(3)(f) subject to payment of tax. So if there is an inward supply for say 17-18 on which I was required to pay tax under RCM, but I paid the tax say in 1920 while filing GSTR 9C. So whether that document would be a valid document only in 1920 since the tax has been paid in 1920, or it would become a valid document in 17-18 itself, and since the tax has been paid after the time limit of section 16 subsection 4, therefore the claim of credit would be straight away denied. In my opinion, this is again an area of legislation where we can argue in case the need arises that my document for RCM becomes a valid document only on payment of tax as per Rule 36(1)(b), and since tax has been paid in 1920, so therefore it becomes a valid document only in 1920, and even if Section 16(4) time limit applies, it would apply with effect from 1920, not from 1718. Again, this is a matter of contention, but this is a contention. This is a submission which we can validly take while arguing the matter. The third question. Now, 16(4) provides a time limit that a credit can be claimed till September of next financial year or furnishing of annual return, whichever is earlier. Now, before going and discussing that time limit, let's discuss the scheme as was originally envisaged at the time of bringing GSTR 1, 2 and 3 vis-a-vis section 16 subsection 2. See, what does section 16 subsection 2 say? It says that I should have a valid document. Second, I should have received the goods. Third, the supplier should have paid the taxes. And fourth, the return in under section 39 should have been filed. So if I see all these four conditions, they are somewhere inbuilt, have been designed according to GSTR 1, 2 and 3. When the law says that the recipient should have a valid document, that means that the supplier should have issued that document, and once the supplier has issued that document, he should have filed GSTR 1. Once he has filed GSTR 1, it would have reflected in my GSTR 2. So the first condition, that recipient should have a valid document, is supported by GSTR 1, because if the supplier issued, he would be showing that document in GSTR 1 and that would have been reflected to me in my GSTR 2. Second condition says that if I have received the goods or services, the second condition says that I should have received the goods or services. So therefore, if I would have received the goods or services, I would have accepted that credit in GSTR 2, and that credit would have that credit would have gone to my electronic credit ledger. Third, once I have accepted the credit and the field would have been frozen, then that outward liability of supplier would have directly flown into his GSTR 3. And once it would have traveled to his GSTR 3, it would have been mandated upon him to pay the due taxes, and by paying that due tax, section 16(2)(c) condition would have been complied. And fourth, once I have accepted the credit and it would have credited to my electronic credit ledger, I would have to file my return under section 39. So this was how the scheme of the things were there, that supplier would file GSTR 1, I would accept that credit once I have received those goods or services. Third, once I have received or the liability of supplier has transferred to his GSTR 3, he would have paid the taxes and then I would have filed my own return. But for the purpose of claim of credit by the recipient, it was not a condition that he should have paid the due taxes as a recipient. But what is happening now? Supposedly, I have to file my GSTR 3B of say March 2020. I have an outward supply of say 1 lakh rupees and I have an inward ITC of say 60,000 rupees. So for the purpose of claim of credit of 60,000 rupees, I am required to deposit 40,000 rupees at the time of filing of return. And if I am not able to deposit that 40,000 rupees, I am not able to claim the credit of 60,000 as well. So if I go through the agenda to 31st GST Council meeting held on 22nd December 2018, It provided that a perusal of above provision indicate that law permits furnishing of return without payment of full tax as self-assessed as per the said return, but the said return would be regarded as invalid return. Thus, although the law permits part payment of tax, but no such facility has been yet been made available on the common portal. This being the case, a registered person cannot even avail his eligible ITC as he cannot furnish his return unless he is in a position to deposit his entire tax liability as self-assessed by him. This inflexibility of the system increases the interest burden. So there is a categorical admission that although the law permits part payment of tax, but the system is not allowing me to claim the credit if I am not able to pay the full tax amount. So in cases of section 16(4), there can be two situations. One is wherein my liability is say 1 lakh rupees and my credit is 60,000 rupees, and for the purpose of claim of that 60,000 I am required to deposit first 40,000, then only the credit would be posted. Then in such case, if I am short of funds or I am able to prove that I did not have sufficient funds to deposit that tax amount, I can very well say without challenging the wires of section 16 subsection 4 that the system is going beyond the law when it is asking me to deposit the tax for the purpose of claim of my credit. This is the inflexibility of the system which has not allowed me to claim the credit. So in such case, I would not be challenging the wires of 16 subsection 4. I would only challenging that the system is going beyond the provisions of the law, and that is very well supported by the agenda to GST Council meeting held in December 2018. Secondly, supposedly my liability is 1 lakh rupees and my ITC is 2 lakh rupees. In such cases, I am not required to deposit any tax. So therefore, in such cases, I cannot take plea of that submission. But what I can do is, I can challenge the retrospective amendment to Rule 61(5), which provided from 9th October 2019 that 3B is required to be furnished, and once 3B is required to be furnished, no return in form GSTR 3 would be required to be furnished. So this retrospective, how this retrospective amendment can be challenged? Say up till 9th October 2019, there was no clear mandate that if 3B had been filed, GSTR 3 would not be required to be filed. But government brought in a retrospective amendment due to the judgment in ARP and Company that if 3B has been filed, that would be treated as return under section 39(1) and no return would be required to be furnished in form GSTR 3. But if we go through the notifications, I have provided copy of two notifications. One is the notification dated 28 June 2019, notification number 28/2019, and second is the notification 9th October 2019, that is 46/2019. Both are the notifications which provided the time limit for furnishing of GSTR 1. It is not important that what time limit was provided for furnishing of GSTR 1, but I would like to highlight the para number 2 in each of these two notifications. In para number 2 of the notification 28 June 2019, it was provided the time limit for furnishing the details of return as the case may be under subsection 1, under subsection 38(2) and section 39(1) of the said act for the month of July 19 to September 19 shall be subsequently notified in official gazette. So the notification for GSTR 1 on 28 June 2019 clearly provided that they would be notifying time limit for filing of return of GSTR 3 under section 39(1). So there was a continuous assurance till 28 June 2019 by the department that we would be bringing GSTR 3. And we will be notifying the date when you have to file GSTR 3. But when the notification when the amendment was made in Rule 61.5, the retrospective amendment for holding 3B as a return in place of GSTR 3, if we go through the relevant notification for GSTR 1 for October 19 to March 20, para number 2 now only provides the time limit for furnishing the details for return as the case may be. Under subsection 38.2 of the said act for October 19 to March 20 shall be subsequently notified. Now there is no reference to section 39.1. So there was I have forgot to provide the case law, but there is a very old case law by Honorable Odisha High Court in somewhere in 1951 or 1952, when they provided that if the government makes someone to believe that something is going to happen, that person is well within his ambit to believe that that thing would be happening. And in this case, till 28 June 2019 and for the period up to September 2019, they were continuously providing in these notifications that amendment, that GSTR 3 would be made applicable. And there was a circular dated 2nd September 2017 which provided that if a person has not claimed the credit, he can claim the credit in GSTR 3. So up till September 19, there was a clear provision that 3 would be brought and GSTR 3 would be the return, 3B is not the return. So this is one thing which we can very validly take, that there was another thing, that these previous notifications which have been there for notifying the due date of GSTR 1, and in all those notifications, para 2 is providing the same thing as has been provided herein with for GSTR 3. These notifications have till date not been amended. This para number 2 is there in all the notifications. Government has not amended those notifications. So even if by 61.5 they have made a retrospective amendment, but till September 2019 they have clearly provided in all these notifications that we would be bringing GSTR 3, and I was being made to believe that I would be filing GSTR 3 and I would claim the credit in GSTR 3, the leftover credit, since till that time 3B was not a return, only GSTR 3 was a return. And last but not the least, since I am going beyond the time limit is approaching for conclusion of the session, and the topic is such that we can go on and on for discussing. But the last point which I would like to discuss for section 16 subsection 4 is, if we go through section 16.1, it says that every registered person shall be entitled to take credit. If I go through section 16.4, it says registered person shall not be entitled to take input tax credit. I am specifically emphasizing on the word taking. This is one, what I can say, drafting of the act, that they have used multiple terms in the act for claiming of input tax credit. Somewhere they have said avail the ITC, somewhere they have provided take input tax credit, somewhere they have provided claimed input tax credit. So there is no unanimity in the law regarding the claim of credit to be made. And in section 16.1 and 16.4, they have referred the term entitled to take credit. But section 16.2, which is an overriding effect on 16.1 and 16.4, it says, notwithstanding anything contained in this section, it is overriding 16.1 and 16.4, no registered person shall be entitled to the credit of any input tax. Now 16.2 is only providing for entitlement, whereas 16.1 and 16.4 are saying taking the input tax credit. So when I am entitled to credit, then only I would be taking the input tax credit. And once I am entitled to the credit, because I have satisfied all the conditions, and because section 16.2 is having an overriding impact on 16.4, then the time limit provided in 16.4 is not applicable to me. Because once I am entitled, see 16.2 provides 4 conditions: valid document, receipt of goods, payment of tax by the supplier, which I can say it is impossible on my account to fulfill, and 4th, which is in my hand, the filing of return in the section 39. So 3 conditions which are in my hand, 16.2A, B and D. I have fulfilled those conditions. Now I'm entitled to the credit. Once I'm entitled to the credit, this is my vested right. And since 16.2 is overriding 16.4 and my entitlement stands fortified, so therefore 16.4 time limit is not applicable even if 16.2 is even 16.4 time limit is not applicable because I have satisfied 16.2. See, if they had 16.2 being subject to section 16.4, no registered person shall be entitled to the credit. Had it been drafted like this, then the time limit provided in 16.4 would have overridden 16.2 and 16.2 would have been subject to 16.4. But as the things stand today and as the law has been drafted, 16.2 is having an overriding impact on 16.4, and once I have satisfied the conditions provided in 16.2, I am vested with my right, and once I am vested with my right, even if the credit claim goes beyond 16.4, it is not impacted because 16.2 is having an overriding impact. The discussion on how the scheme of the act. See, the power of the government or the legislature to provide a time limit is not doubted here. It is undoubted. But my contention is 16.2, which provides about entitlement. And once I have satisfied those conditions of entitlement, I am vested with my right. And since 16.2 is overriding 16.4, therefore 16.4 time limit is not applicable since 16.2 is satisfied. So this is a brief discussion, although there have been only 3 sections provided, but this is a brief discussion on the topic of 16.4. We can go on and on for 16.4, Rule 36.4 and 16.2c, but given the time frame, I have tried to do the justice with the topic. And thank you once again to Visakhapatnam branch, the chairperson and the organizers of Sub-Regional Conference for giving me this opportunity for sharing my thoughts. I hand over the session back to the organizers. Thank you very much.
Thank you, sir. That was really a wonderful session. Today we had on dot, you have stopped the session. Thank you for the time you have allotted. I request our treasurer, I request members, if they are having any queries. In the chat box, we have got one question regarding while you are talking. Did
Yes,
you
sir.
see
That is CP
grievance
Gram.
portal?
Yes.
PM grievance portal.
CP Gram. That is Prime Minister grievance portal.
Any members having any queries, they can unmute themselves and speak with the speaker.
And one thing I would like to add is that we have very successfully used this Prime Minister grievance portal in cases wherein the refunds have not been received by the assessee even after filing of return or in some other administrative matter. So we can very well use this facility of Prime Minister grievance portal in case of large demand cases.
Excellent, sir.
Yes, sir.
May I know under which section, without on part payment of tax, can we file the returns under GST?
Section 30, if you see section 39(7), it says that a return would be valid only if the taxes have been paid. So a valid return is for the purpose of matching of ITC, but for the purpose of claim of ITC, there is no requirement of a valid return. And that's why the agenda to the GST Council meeting said that once a return has been filed without payment of or part payment of taxes, it would be invalid return for the purpose of matching of ITC as per section 13(9)(7). But if we are not allowing the filing of return with part payment of taxes, it is somewhere creating a hindrance for the purpose of claim of ITC, which is not there in the law.
Thank you, sir.
Hope the members are clear their queries. Madam, shall I continue with vote of thanks? Good evening, respected chairperson, respected speaker, and all the dignitaries participated in the virtual AP state level sub-regional conference. Just we had experienced a spontaneous and illuminated deliberations on the controversial issues under the GST on section 16 of 2, 16 of 4 and rule 36 of 4 by our respected speaker CA Arpit Haldia. His elaborated explanation with proper case laws on the section 16 of 2 and 16 of 4 made our members very comfortable, and his studying back explanations make our members comfortable even in the controversial issues matters of ITC with the supporting notifications and latest issues notifications of by the GST Council. Sir, your deliberations on the ITC utilization, when and how, and what is the procedure to crack the critical issues relating to the Rule 36 of 4 is very much enlightened and enriched our members of AP State and all branches of our members. Sir, on behalf of me, myself, and on behalf of our branches of AP State and on behalf of our Visakhapatnam branch, from the bottom of our heart, we are very much thankful to you and for your great session, and we request your physical mode session in coming future, and I request the same to our chairperson. Thank you very much, sir, from the bottom of heart, and I also thank to PVSP Kumar Garu for helping us and guiding us. This is the great speaker to us. With this, we came to second day, first technical session, and I request to chairperson to further proceed in the conference.
Thank you, sir. Thanks a lot. As our next technical session speaker has already arrived.
Thank you, ma'am.
Ms. Shruti.
Yes, ma'am. Thank you so much. So, very good evening to all the delegates who are present here for the AP State Sub-Regional Conference Day 2, second technical session. The session is on the topic Special Purpose Audit Report, Certifications and Latest Developments in Company Law. It's my pleasure to introduce today's speaker, who's an expert on the subject of discussion, our respected Central Council member, CA Dr. Debashish Mitra. So Dr. Mitra is a chartered accountant by profession, and he also holds various degrees, being a cost accountant, a company secretary, a law graduate, master's in commerce, a qualified information systems auditor, and he's also been awarded a doctorate for his thesis on critical study of selected Indian GAAP, US GAAP, and IAS IFRS. A trainer on international financial reporting standards and presentation of financial statements for many corporate and non-corporate entities. He's also been a trainer on corporate laws for the central state PSUs, for the Comptroller and Auditor General of India, and also various state government officials. He's addressed numerous conferences of Chamber of Commerce and reputed institutes in India as well as abroad. Being re-elected to the Central Council, he has been re-elected for the term of 2019 to 2022. Currently, he is the chairman of Board of Studies Academic of ICAI and also the vice chairman of Auditing and Assurance Board. He's been nominated as the member of Quality Review Board established by Government of India and also nominated to the Board of Extensible Business Reporting Language India. He has been the member of the auditing group of Confederation of Asian and Pacific Accountants and also the chairman of the Committee on Education, Training and Continuous Professional Development of South Asian Federation of Accountants. Being the former national president of the Institute of Internal Auditors, he is presently the president of Accountants Library, one of the oldest accounting institutions in India. Well, with this introduction, we need no more definitions or reasons to find a better expert than him on this subject. Sir, hoping your expertise will help us clear the airs on a lot of issues concerning the topic of discussion. We welcome you to the conference, sir. You may please take over. Thank you.
Use a PowerPoint, I will speak extempore totally, because I would like to be in direct conversation with the members. First of all, thank you very much for inviting me, Visakhapatnam branch. My council colleague from this branch, Prasanna Kumar, the chairperson, managing committee members of the branch. Last time when I had come here, see, there was a shortage of time, and I can see that you have carried my picture, photograph, when I was speaking last time. It is such a big pleasure, a big privilege on my part to come and address all of you. My topic today is on, reporting auditing standards on Companies Act. The topics are diverse. The recent changes in Companies Act and the auditing standards, the topics are diverse. I will take you step by step and in a very layman's language about what is happening on the auditing standards, and maybe link it up with the accounting standards, and then take you through the examination of prospective financial information, special purpose reports, which you wanted, and of course, the changes that have been brought about by the Companies Amendment Act 2020. First of all, let me take you through auditing standards. Auditing standards were issued by the Institute of Chartered Accountants of India before, but till 1/4/2014, these auditing standards did not have a legal sanction, in the sense that, the Companies Act did not say that you had to follow these auditing standards. From 1/4/2014, there was section 143, subsection 10, introduced in the Companies Act. And this section says that every auditor has to report on compliance with the auditing standards. And these auditing standards at the present moment are 46 in number. And I'm sure the branch must have organized programs on auditing standards, because the institute has made it mandatory that 2 hours of program on auditing standards and 2 hours on ethical standards. So it is very important that we understand the rudiments of auditing standards before I go ahead. So 46, I said about the auditing standards. Please note, you must distinguish auditing standards from accounting standards. Auditing standards are only one set of auditing standards. Somebody was asking me the other day before yesterday, that Debashish, is there any auditing standards for separate auditing standards for small enterprises? And I said that we do not have a separate set of auditing standards for small enterprises, even though the institute at the present moment is deliberating on the need for such standards. But I would like to make a distinction, with section 143.10 of the Companies Act with section 133. Now, section 133 of the Companies Act lays down accounting standards. Please note, earlier I spoke about auditing standards. Section 133 talks about accounting standards. Now, accounting standards, we have two sets of accounting standards. One set of accounting standards are issued under the Companies Accounting Standard Rules 2006, which was notified on the 7th of December 2006. So that is one set of accounting standards. And I'm sure those of us, most of us, who are practicing in the Andhra Pradesh state, we should be accustomed to this set of accounting standards, which have been there as per the Companies Accounting Standard Rules 2006. But then we have another set of accounting standards that's called the Indian Accounting Standards, the Ind AS. And the Ind AS, which has been brought into effect from 2015, and if you are a listed company at the present moment, or a company having a net worth of 250 crores or more, if you are an NBFC, you have to follow accounting Ind AS. So please note, in the case of accounting standards, we have two set of frameworks. One is the AS, which was as per the Companies Accounting Standard Rules 2006, and the other is for bigger listed companies having net worth of 250 crores or more. So those kind of companies, we have a separate set of accounting standards, and which is called the Ind AS. So at this present moment, I hope I have just taken you through the rudiments of auditing standards and accounting standards. Now let me come to You see, when I will be speaking to you, I'll be talking about balance sheets, and I'll be talking about format of balance sheets, etc., etc. So let me take you through Schedule 3 to the Companies Act. Now, Schedule 3 to the Companies Act lays down the format of the financial statements. Please note, Schedule 3 contains the format of the balance sheet and PL. It does not contain the format of cash flow. And if you're talking about cash flow, you see the way you need to prepare the cash flow is contained in AS3. And AS3 talks about two types of cash flow. That is, direct and indirect method of preparing cash flow. And those of us who have been preparing cash flow, please note that indirect method is easier than the direct method when you're preparing the cash flow. But I was telling you about Schedule 3. Now, Schedule 3 contains the format of preparation of financial statements, balance sheet and PL, and it has three divisions. Division 1, which contains the format for preparation of balance sheet of a non-Ind-AS company, non-Ind-AS. Division 2 contains the format of balance sheet and PL for an Ind-AS compliant company, and Division 3 contains the format of balance sheet and PL and disclosure requirements for the NBFCs, and this format has been made applicable from 2018-19. Schedule 3 to the Companies Act, which contains the format of balance sheets. Now, as I will go ahead, I'll talk to you about cash flow statements and things, balance sheet PL. I'll tell you. About 2 years back, I have an office in Calcutta. So this gentleman, he sought for an appointment with me and said that, Dr. Mitra, can I come and meet you? I said, all right, please come and meet me. And he came in, and you see, I gave him a time of 11 o'clock in the morning, and he came in at 11 o'clock in the morning. And he said, he was quite furious. He said that I want you to write a complaint letter against the ROC. The ROC at that time. I said that, why do you want me to write a complaint letter? He said, look, I am a small private limited company. And when I speak all this, give you illustrations, I'm keeping in mind Visakhapatnam and the other branches which has organized this conference. I'm a small private limited company. And I have signed the audit report containing the statement of profit and loss and the balance sheet. I did not have the cash flow. Now, the company has now got a notice for the register of companies saying that why you did not prepare the cash flow statement. And he was saying that, look, according to my understanding, cash flow is required to be prepared by big companies, listed companies, public companies, etc. So I told him that, can you tell me what is the paid up capital and what was the turnover of the company for the year for which you have received a notice from the register of companies? He told me that, look, Dr. Mitra, the paid up capital was only 20 lakhs. I said, very nice. I said that, can I know the turnover of the company? He said that the turnover of the company was only 2 crores 21 lakhs. And he said that, look, small company, and nowadays, what is 2 crore turnover? Nothing. So he was telling me that that is what is the turnover of the company. And he looked at me and he said that now you must write that letter to the ROC. You see, he's senior man, and he said that, look, I don't know the legal jargon so much, so you must write that letter. I said that, sir, if you don't mind, I think the ROC is right in issuing that notice. And he was quite surprised when he heard this. He said that, why do you say so? I said that, sir, if you want to, go for the definition of financial statements, you have to refer to a section called Section 2, subsection 40 of the Companies Act. It defines the financial statements. And it says that the financial statements are, in the case of a company, are a balance sheet, a PL, a cash flow, and the statement of changes in the equity shares, but you are not required to prepare a cash flow if you are a dormant company or if you are a small company. You are not required to prepare a cash flow. And I said that, what is the definition of a small company? The small company definition is, it has to be a private limited company whose paid up capital does not exceed 50 lakhs And at the present moment, let me tell you, this is the limit as the present moment, and whose turnover does not exceed 2 crores. And both these conditions of paid up capital 50 lakhs, turnover 2 crores must be, they have to be fulfilled together. I said that, sir, in your case, the turnover is less than, the paid up capital is less than 50 lakhs. It is 20 lakhs. I can understand that. I have no problem. But the turnover is more than 2 crores. It is 2 crores 21 lakhs. Consequently, it is not a small company. If you are not a dormant company, in that case, you have to prepare cash flow. So he heard me out. He said that, look, you must popularize this concept to all chartered accountants, because many of us are of the belief that cash flow statement is not required to be prepared for small companies. Please note, that's why I took this opportunity to start off with this point, that cash flow statement is not required to be prepared for a small company or dormant company. But, and I have also given you the definition of a small company. So for other companies, cash flow statement is required to be prepared. So those of us who are going to, certify balance sheets this time, please note that you have to prepare cash flow. You have to prepare. I will sometimes mix up. Please note, this time the deadline of having the AGM is December 31st. Tax audit is December 31st. So everything is extended, but it is time that we started completing the accounts. Please note, you cannot backdate things too much, because the UDIN cannot be backdated more than 15 days. So you have to plan things and do things accordingly, even if you are the auditor of a small private limited company. So that is the second point. I am now coming to this auditing standards and the topic that was given to me, that you see on the prospective financial special purpose financial special purpose audit and audit of prospective financial information. Before doing that, let me take you through 4 standards, which are the reporting standards, mother standards. One is SS 700. And don't get scared, those of us who are not very conversant with these numbers and all this, don't get scared. You see, it is nothing, it's just, remembering, the small little things. SS 700. It's in the case of a company, you have a audit report format, independent auditor's report. Unlike in the case of a tax audit report form number 3CA, 3CB, it is under section 44AB of the Income Tax Act, where with rules there under. But here, in the case of a company, when you are doing the company audit, please note, the Companies Act does not lay down the format of your audit report. The format of your audit report is contained in SS 700, which is an auditing standard. It starts off with the independent auditor's report, and then it goes on to say responsibility, the management responsibility, and it goes on to say, please note, the report that you sign, it says that we are giving a reasonable assurance. We are not giving an absolute assurance. We are not giving a guarantee. If you see the report, we are not giving a guarantee that all aspects, we are not giving a guarantee that all fraud or misstatements could be detected by us, because of the simple reason that we do testing. So we are not giving a guarantee, and this word guarantee has been carried in this auditor's report, right? In the format of the auditor's report as contained in SS 700. So, when I will talk about the assurance, when I talk about this, the different types of assurance, I will talk to you at that time. But let me tell you, it was last year, sometime in the month of October or November, I was speaking at Delhi on auditing standards, and you see, there was a very big crowd. It was in a big hotel in Delhi, and I was speaking on this standard, SS 700, and then the topic that you have told me about, you see, examination of prospective financial information and how to report, special purpose reporting, all those aspects were also part of my topic. They were also part of my topic. So I was asked to speak on this. So I was speaking. Now, one gentleman, this young gentleman, he stood up when I finished speaking, and the question answer came. He said that, and at that time I was using the PPT, and I was showing them the format of the auditor's report. If you recall the format of the auditor's report that we signed, please note, we have carried out the audit of the standalone financial statements of X and Company Limited or X and Company Private Limited. Please note the word standalone. And we write about this standalone, right? Please note the word standalone. Now, in this case, this gentleman, young gentleman, he said that, sir, we are writing the word standalone. I said, yes, we are writing the word standalone. I'm sure so many of you might have also written the word standalone when you went ahead, when you have signed the audit report last time. So he said that, sir, standalone, I will give you an example. I said, tell me. He said that, sir, I am doing the audit of X and Company Private Limited. I said, okay. And sir, when I'm doing the audit of X and Company Private Limited, I'm using the word standalone because I'm doing the audit of one single company. Am I doing the right thing or am I doing the wrong thing when I'm using the term standalone when I'm giving the auditor's report, which also is going to be taken up when I take up the specific topics eventually. Many of the seniors who were present in the meeting, they were, some of them were smiling a bit. They said, the basic thing. So I asked this question that I asked the audience that what is your viewpoint? Is it right or is it wrong? Many people did not, because auditing standard is not a very, very popular topic, unlike GST, etc. But many of them, they said that, see, he's right. So I said that, Mr. X, unfortunately, you are wrong. He said, why, sir? I am doing one small audit of X and Company Private Limited, and I have started writing my auditor's report. We have carried out the audit of X and standalone financial statements of X and Company audit of X and Company Private Limited. So you cannot say that I am wrong. He said that, I said that, what does standalone mean? When you write standalone, it is to indicate that the company that you are auditing is part of a bigger group. For example, there is a holding company, there is a subsidiary company, there is an associate company, there is a joint venture. And you are doing the audit of an associate company. Then when you write, if you are doing the audit of an associate company, you can write standalone to indicate that this associate company is part of a bigger group. There is a holding, there is a subsidiary, there is a JV, and I am just doing the audit of one of the group companies. And that a CFS is prepared, a consolidated financial statements is prepared later on to consolidate the accounts of all these four companies. So when you are writing standalone, let me tell you, it is to indicate that the company that you are auditing is part of a bigger group. So those of us who are going to sign an audit report this time and write X and Company Private Limited, which is not part of a group, please do not use the word standalone before that. When you are writing the audit report, we have audited standalone, do not write the word standalone. If it is part of a bigger group, do write the word standalone. So that's the first thing when I was telling about SS 700. So SS 700 goes on to speak about, reporting under CARO, etc. Please note that this time when you are reporting, you have to report CARO 2016 for 1920. From 2021 onwards, the CARO that will be applicable will be CARO 2020, for which the Institute has already issued a guidance note. On CARO 2020 also, we have issued I am the Vice Chairman of Audit and Assurance Standards Board. We have issued a guidance note on the 1st of July 2020. And those of us who would be interested in doing Division 1, Division 2, and Division 3 of Schedule 3, please note on each of these divisions, the Institute has also issued guidance notes. So you may, if you have any confusion, you can refer to these guidance notes that the Institute has issued. So this is about SS 700. I'm coming to SS 705. SS 705 talks about modification of audit report. Modification means qualification of audit report. When do I qualify my audit report? In what circumstances do I qualify? Please note, when you give an audit report, you can give a clean audit report. You can give a modified audit report. You can give an adverse audit report, or you can give a disclaimer. 4 types of audit reports are there, and this is what SS 705 talks about. A clean audit report, all of us who are listening to me at this point of time, I'm sure you are all aware that a clean means balance gives a true and fair view. That is a clean audit report. A qualified or a modified audit report is, it's when we state that this is, the debtors are subject to confirmation, or the inventory has not been valued at cost or market cost or net realizable value, whichever is lower, AS2, in AS2. So subject to the above, the balance sheet gives, the financial statements gives a true and fair view, subject to the above. So in that case, you have a qualified audit report. Adverse audit report is when you write that the financial statements do not give a true and fair view. That is an adverse audit report. And disclaimer is, when you don't get evidence, you do not get any kind of evidence, and consequently you write that because of lack of evidence, we are not in a position to state whether the financial statements give a true and fair view or not. So please note, clean, qualified, adverse, and a disclaimer. That is SS705. SS700 I've told you, SS705 I have to say that these are the 4 types of audit reports. SS705 goes on to say a lot of things. But these, if you can catch hold of this 4, it is very good. If you want me to say more on this, if you have any queries on this, I would like to take my queries because I would like to finish up at about 6:30 in about half an hour, 40 minutes time. And then I would like to take queries if there be any from your side. Right. So that is about SS705, which talks about modification of auditor's report. Then we have SS706, emphasis of matter and other matters. Now, what is emphasis of matter and other matter? SS706. Now, suppose you want to emphasize on something which is there already in the notes on accounts, but at the same time, yes, I've seen a question coming on standalone. I will take it up. Don't worry. I'm very open to questions. I would like to have an interactive one. Right. Very nice that you have started talking about standalone. I can see a question coming up on standalone. So the question is, sir, we are using, in case if you require to prepare, please do confirm. All right, I'll come to, I have already got 2. I will take all of them taken together because otherwise, and let me tell you, I will take up all the topics that have been given to me in this conference. I'm just trying to build up because these are certain things which, as the Vice Chairman of Audit and Assurance Standards Board, I feel are very, very important for you to know. So I was talking about emphasis of matter. Suppose you have a situation where the debtors or trade receivables, for that matter, I am sure you write all of us that in the notes on accounts that the trade receivables that are pending confirmation and reconciliation. I'll take a very simple one. I'm sure we write that trade receivables are pending confirmation and reconciliation. We write that. I do not want to qualify. At the same time, I feel that this is so important, I want to bring it to the main body of my audit report. So what do I write? I write reference is made to note number 2 of the notes of the financial statements, which states that trade receivables are subject to confirmation and reconciliation. Full stop. Next line you write, our report is not modified in respect of this matter. That means you are saying, I think it is so important. It is there in the notes on accounts. I am bringing this in my main audit report. At the same time, I am not qualifying. At the same time, I am not qualifying. So please note. So that is emphasis of matter. Please note, emphasis of matter is not an alternative to qualification. Many of us, Economic Times carried an article about 2 to 3 years back that, many of the auditors, they want to camouflage their qualification by using emphasis of matter. Please note, if you want to qualify, please go ahead and qualify. Do not use emphasis of matter as an alternative to qualification. Now, those of us who are asking me questions, let me also tell you, pre-2014 days, pre-2014 days, before Companies Act 2013 came into play, If you had to qualify, we had to use bold letters or italics, because if you had to qualify. Today, we don't have to use bold letters or italics if you want to qualify. It is basically because, you see, in the old Companies Act, in the Companies Act 1956, there was a section called Section 227. And that section said that if you want to qualify, please use bold letters or italics. That was not an instruction from the Institute of Chartered Accountants of India. Subsequent to the coming into force of Companies Act 2013, that instruction that was carried in Companies Act 1956 has been withdrawn. Consequently, if you are going to qualify, you are not required to use bold letters or italics compulsorily, but there is no prevention of you using bold letters or italics if you so desire. If you so desire, you can use bold letters or italics. So that is about emphasis of the matter. What is other matter? Other matter is, I want to add something to my report, which is an example. I am the CFS. I am the auditor of CFS. But I also want to write that I did not do, or suppose I am the auditor of a company which has branches, and I have not done the branch audit. So I want to write that, look, I have done the consolidated audit, but I have not done the branches audit. So that aspect you can write in the other matter, that you have not done the branch audit, but you are doing the audit of the CFS, consolidated one. So see, that is called the other matter. So I have taken you through SS 700, SS 705, SS 706, and of course there is SS 701, which talks about key audit matters. Please note this standard on key audit matters, which many of us have used during the pandemic when we were doing the bank audit, is only applicable for listed companies. For other companies, it is still optional. So that is SS 701. Now let me straight away come to one of the topics that has been assigned. Now at this stage, I think all of us are mentally quite attuned that, all right, this is auditing standards. This is the kind of environment in which I have to do audit, right? So let me now take you to SAE 3400. That is, reporting on forecasts. I'm coming to you, so nice to see so many of you reacting. That is very, very good. A speaker feels good when he finds a lot of questions. I'm coming to that. By the way, on key audit matters, there is an implementation guide also, SS 701. Right. So you see here now, let me tell you, I'm coming to SAE 3400, which talks about examination of prospective financial information. Right, and this has been made this standard is applicable from 2007. Now, there is a projection or there is a forecast. Okay. Now, a management has made a lot of assumptions and prepared forecasted financial statements or projected financial statements. Please note, I have made a distinction between forecasted and projected financial statements. And the assumptions made by the management are very clear that these are the assumptions. You have been asked to report on those assumptions or on those financial statements. Question arises, can I report on the truth and fairness of those financial statements which are in the nature of forecasts or which are in the nature of projections? This standard, SAE 3400, says that what you can report on is that to what extent the assumptions are right. To what extent you feel that the assumptions are justified. You cannot give an assurance on the truth and fairness of the financial statements. You cannot give an assurance. Now, let me make a distinction between forecast and projection as contained in SAE 3400. This standard says that a forecast means you project your financial statements based on events which are expected to take place, right? And But a projection is that you are not sure whether whether you see that event is expected to take place or will take place, and then you make that projection. Please note, in the first case, expected to take place, and you see here, not necessarily in the case of projection, not necessarily expected to take place. For example, you have a startup. A startup, I can prepare the projected financial statements for 10 years. Now, I don't know to what extent the startup will be some projections. Now, you have a hospital which is running, an existing hospital, and you have been asked to make a forecast based on historical data of the past 3 years, and you make a forecast. That is, you already have an existing hospital, you are making a forecast of the future. So that is called, based on historical data. So that is called, a forecast. So here, please note, in the case of projection, the event may not necessarily take place. But in the case of forecast, based on historical data, there is a possibility of the event taking place, right? So what we do is, in the audit, in the report that we do in the SAE 3000, we do not give an assurance. We do not give an assurance of the truth and fairness of the financial statements. We only say that, assurance, a moderate assurance on the assumptions that have been made, on the evidence that has been provided. So on those, we can give an assurance, moderate assurance. Now, when I talk about assurance, please note, we can have 3 types of assurance. Even a moderate assurance is there, but basically 3 types of assurance. We have an absolute assurance, true and correct. We have a reasonable assurance, true and fair. We have a limited assurance. Those of us who do limited review of financial statements, we do limited assurance. So that is, we give a limited assurance for that. So please note, assurance can be of 3 types. Here, we are not giving a reasonable assurance. We are giving something which is a limited assurance, and we are not, as I repeat, commenting on the truth and fairness of the financial statements. And please note, when you are doing this kind of certifying on this kind of projections or this kind of forecasts, please note, please write that this has been totally prepared by the management. We have not prepared this. It has been prepared by the management. That's very, very important. And please note that you must write that we are here only to give comment on the assumptions made by the management and nothing more, and the evidence provided. So that is very, 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 very important. And if there is a negative assurance, you have to give negative assurance. Now, here I come to, next is SA 800. I'm moving from 3400 to SA 800, which talks about special consideration in audit of financial statements prepared in accordance with special purpose. Now, suppose you have a contract clause, and in the contract clause, they say that you have to give prepared financial statements regarding only on the turnover. Or there is a contract clause which says that, you have to prepare financial statements only on these aspects. Please note. So in the case of special purpose financial statements, what we do is this. First of all, we do not comment on IFC, internal control or internal financial control. We do not comment. We only comment on that aspect of the financial statement on which, that special aspect on which we are required to comment. And please note, in these cases, if at the end we have also prepared a general purpose, we have not, the company has prepared a general purpose financial statement. That's a balance sheet, PL, and a cash flow. And on that also, we have given an opinion. You are supposed to use the other matter paragraph and write that here I am giving an opinion only for these special issues, but I have given a separate opinion on the entire financial statements, and a separate opinion has been dated this. So that you have to write in the other matter in this kind of issues. So I will repeat, in both the in the first case, when you have a forecast or you have a prediction, please note we cannot certify on the truth and fairness of the financial statements. We can only say that it has been based on evidence, historical data, and the assumptions to see whether they are okay or not. So you see, we cannot do that. And in the case of next one is a special purpose financial statements. What we do is this: we only certify on that aspect, or on that aspect of the financial statements which have been prepared in compliance with a particular law. And then if you have certified separately the full financial statements, in the other matter paragraph, we write that yes, we have certified the full financial statements. So that is about auditing standards at this stage. I'm already at about 6:15. I think I will speak for another 15-20 minutes, and then or whatever you want to. I will now go to Companies Act. Right now, Companies Act, we have had this CLSS scheme. Right, see, we are all having the Companies Fresh Start Scheme 2020. Now, you see, those of us who have not availed of this scheme, please note it's there till 31st of December. And it says that, you see, if you want to file documents which you did not file before, if you want to file documents which you did not file before, you can do so by only paying, without paying any additional fee. You pay the normal fee, and no prosecution or penalty will be imposed against you. No prosecution or penalty will be imposed against you. And and in that case, and please note, those of us who deal with this DIR3 KYC, you have to file before you have to go. But please note that no fee of rupees 5,000 for DIR3 KYC if you want to go for this scheme. And you see, an INC 2022A is also required to be filed, right? So this is very important. Even for DPT3, you can use this form to file this form, right? Now, you see, a question is rising that they have given this example. You know, if you are having a return of allotment of shares, you see, those of us who are a bit old timers, please note that in the earlier times, we used to file this return of allotment in form number 2, and now it is, the form now is PAS3, PAS3. Now, the return of allotment, you have to see file within a particular time frame. And it is said that till you file this return of allotment, you cannot utilize the money that you have got, the share application money you have got, till you file the return of allotment. Now, this scheme says that suppose there is a delay in filing the return of allotment, you can avail of this scheme. But if in violation of section 48 subsection 2 of the company, 42 subsection 8 of the Companies Act, you have utilized the funds without submitting the return of allotment, then you see that for the utilization of funds, whatever is the penalty, that penalty has to be faced by the company. So that is very important. And then, of course, this scheme is not applicable for companies against which order for striking off under section 248, management disputes, or you see, companies which have amalgamation, government vanishing companies, increase in authorized capital. So those kind of cases you see do not come under this scheme. And please note, once this scheme ends, then you are supposed to, within six months, you are supposed to file a form called CFS 2020. This form is free of cost, no fee for this form, and then you can file this form and get the immunity for all this. This is a good scheme. Please take full advantage of this scheme. There is also the LLP modified settlement scheme also. So also do take advantage of these schemes. These are good schemes, right? So these are the two schemes which I have spoken about. Now let me move a bit towards Companies Amendment Act 2020. Please note that this act has got the assent of the President on 28th of September 2020, but sections have not been enforced as yet. But I will take you through 3 or 4 sections which I feel are very important. And when I talk about those sections, I will also talk to you about the implications of those sections. The first section that I come to is section 135 CSR. I don't know how many of you deal with it. So it's a CSR, section 135. Now, section 135 CSR states that if you are a company having a net worth of more than 500 crores, or a turnover of more than 1,000 crores, or a net profit of more than 5 crores in the immediately preceding year, then you have to spend 2% of the average net profits of the past 3 years for CSR. Please note that. For the past 3 years, average net profits you have to spend for CSR. That is, wherever there's a change, I'll tell you the change, right? And this is the position now, no change on this. Average net profits of the past 3 years you have to spend, right? So you have to give it for the CSR. And a company is also required to form a CSR committee consisting of 3 directors, out of which 1 should be an independent director if the company has an independent director. If the company does not have an independent director, then the CSR committee can have only 2 directors, at least 2 directors, right? And when you choose about which kind of projects to go for under CSR, there is a schedule to the Companies Act called Schedule 7 to the Companies Act, and you can go for the Schedule 7 and choose your project. For example, there are projects on sanitation, there are projects on vocational service. So there are so many projects. You can go and see that Schedule 7 and do them. Please note, as of now, if you have not spent that 2%, if you have not spent that 2% on CSR, then in that case, what you need to do is you have to explain in the director's report by using a format that is there in the CSR rules, and you have to explain why you could not spend 2%. Why you could not spend 2%, right? Now, a question has arisen now that if I have spent extra in 1 year, can I set it off in the next year? As things stands today, you cannot really set it off. But you see, the changes that are being brought about, they are saying that you can try to set it off, right? So this is what the CSR scheme of things is today. And you see, of course, you can even spend on CSR by floating a Section 8 company. You are aware the Section 8 company is there. So you see, you can Section 8 company, or there can be a trust, there can be a society, and you can spend money on CSR. So that is about CSR. Now, what is the change? Change in the Companies Act 2020 and the changes brought by earlier act. Please note, as I told you now, if you don't spend money on CSR 2%, you just explain and no penal consequences are there as of now. There is a change in Section 135(5), which has not been enforced at this stage. Let me tell you, it has not been enforced. But this is a change that has come. They are saying that if you could not spend money on the CSR in a particular year, and if it's an ongoing project means, suppose you have taken up a project for constructing 200 sanitary toilets, out of which you could construct only 50, and the balance 150 could not be constructed during the year. So this is an ongoing project. So then if you have an ongoing project, then within 30 days of the end of the year, the unspent money of the CSR, you have to deposit that in a separate bank account. And you have to use that money within a period of 3 years from the date of deposit. From the date of deposit, with the period of 3 years from the date of deposit, for projects, for the ongoing project. And if you do not use that money within a period of 3 years, then you see, you have to deposit this money in one of the funds that has been mentioned in Schedule 7, for example, Prime Minister's Relief Fund, that is there. They are saying if you don't have an ongoing project, in that case, what you do is this money which you could not spend during the year, within 6 months from the end of the year, please deposit this money in a fund as laid down in Schedule 7, for example, Prime Minister's Relief Fund. So please note, this section 135, subsection 5, now makes it mandatory for you to use this CSR 2% in an ongoing project or otherwise to deposit this money in a separate fund as laid down in Schedule 7. Please note, Section 135, subsection 5 is yet to be enforced. So those of us who are hearing me, Please note that this section is yet to be enforced. It is not enforced as yet. Now, what is the change brought about by the Companies Amendment Act 2020? The change that has been brought about is, they are saying that if your CSR spend is about not more than 50 lakhs, in that case, you need not form a CSR committee. You need not form a CSR committee. Further, they are saying that if you have paid extra in CSR in a particular year, then you can set it off against the CSR expenditure of the subsequent years. Please note, again, this change in the section has not been, right? So this is number one. Now this I'm talking about CSR, right? Now let me now take you through another section. Section 129, capital A. Now what does this section newly introduced by the Companies Amendment Act 2020, which has received the assent of the President on the 26th of September 2020. And you see, it says section 129, subsection A of the Companies Act. It says that for certain categories of companies, the government might require preparation of quarterly financial results. What categories of companies? The government has not mentioned. Please note, if you're a listed company, you have to do it for quarterly. But for unlisted companies, certain categories, the government might say that you have to prepare quarterly financial statements, right? That is number one. And number two, this might be subject to limited review. So what are the kind of companies which will be preparing periodical financial statements and which will be subject to limited review? One really does not know. But that will be specified by the government. I am coming to two sections now, and then I will end. One is section 140 relating to audit, and another is 143 subsection 12 relating to fraud reporting. And then I will take many of your questions. Section 140, you see, talks about auditors. Resignation from audit. Now, this section is very clear. That this section says that 1 minute. I'll just take a call, please, if you don't mind. This section very clearly says that if you have, again, I'll tell you one story. You see, and I will have two stories now, and you'll find both the stories very case studies. These are all case studies, and you'll find those case studies very, very interesting. This was again about 3 years back. Again, this gentleman, not as senior as the earlier gentleman I told you about, he came into my chamber. And you know, like Prasanna Kumar sir that you have here, you see, I being elected council members, the members, they expect us to help them out, and we should also help them out. It's our duty to help them out. So this gentleman, he came and he said that, sir, I have resigned as the auditor of one company. I said, okay, all right, you have done. This is the resignation letter which I have given to the company, and this resignation letter has a stamp, right? So he said, but now I have got a notice from the ROC asking me to pay a penalty of 50,000 rupees, even though I have, you see, already submitted my resignation letter to the company. He said that, look, I have resigned from the company. And why you are, you see, and for the resignation, the ROC is penalizing me. And he was telling me that, look, sir, my audit fee from that company is 5,000 rupees only. And the ROC is giving a penalty of 50,000 rupees to me. From where the ROC got this 50,000 rupees? Do they think that the auditor's minimum fees is 50,000? If they think, then it's very good. And he was very, very furious sitting in my office. I asked him that, sir, if you don't mind, offered him a cup of tea, because he was also quite a senior gentleman. And you know, most of these issues who come to me are senior people, because the junior boys, the younger boys, they know what to do and how to fill up. the senior people, they find it very difficult to comply with the latest changes and to upload forms and things like this. So I offered him a cup of tea. And I told him that, sir, there is a form called ADT3. Did you fill up that form? He said, what is that form? I said that form is a form intimating the ROC about the resignation of the auditors. He said that I have not filled up the form. I said that, sir, the section says that you have to comply with all the provisions of the sections, otherwise you'll be penalized. Then this gentleman told me, and this must be 3 to 4 years back. He said, all right, Mr. Mitra, I have heard you. But then, shouldn't the penalty be limited to my fees? How can you penalize me for an amount which is higher than the fees that I have earned? That is not fair. I said, sir, I totally agree with you. That is not fair. Please note, at the intervention of the institute, that section was subsequently changed. And that section 140 subsection 3, which now reads is, the penalty will be 50,000 rupees or the remuneration last received, whichever is less. So you see, that gentleman's voice was heard. We approached the government and we could reduce that penalty to saying that the minimum penalty should be not more than the last fees earned. That is what we told the government. And the government agreed to us. But the government said, in the case of a continuing default, then the penalty shall be 500 rupees for each day, subject to a maximum of 5 lakh rupees. And we said that, sir, again, you are making a mistake, sir. Why you are again imposing this kind of penalty of 5 lakhs? Poor fellow, he has resigned and you are still trying to make penalty of 5 lakhs. In the Companies Amendment Act 2020, not total relaxation, this 5 lakh rupees, the upper limit for continuing default, has been now reduced to 2 lakhs. It has now been reduced to 2 lakhs. Please note, this Companies Amendment Act 2020 also talks about decriminalization of offenses, So a lot of offenses have been decriminalized now. You see, this is one of the main facets, aspects of the Companies Amendment Act 2020. Please note, I have another more interesting story. This gentleman, day before yesterday, not gentleman, lady, phoned me up at about 8:30 in the morning. She said that, sir, my company in which I have been just appointed as an auditor, I have found that there is a huge embezzlement of funds. I was hearing her in the morning, 8:30. I was just coming back from my morning walk. And she was telling me, sir, I want to resign from the company. I said, okay. But sir, what reason should I give for resignation? She was telling me about the next section, which I'm going to talk to you about, section 143, subsection 12, rigors of that section. She was saying, because of the fear of that section, sir, I'm not willing to. And she said, she was quite sarcastic in the morning. She said that, sir, should I write that because of the fear of going to jail, consequent to the promulgation of Companies Act 2013, I'm resigning? Should I write like this? I laughed at her. I said, you write anything that you want to. So you see, whatever may be the reasons, she was saying that, sir, I'm having ill health because see, she had suffered from corona. She had got better. So I said, write that. That will be a very good excuse, very good reason for this, right? So please note. So you see, this is about the resignation of auditors. I come to fraud reporting, section 143, subsection 12 of the Companies Act, which has been amended in the Companies Amendment Act 2020. But let me tell you what is there now and what is yet to be enforced. What does this section say? This section says, and this is for all auditors, let me tell you, private limited company auditors, small company auditors, any company auditors, no exception, no exception. And here I'll tell you an interesting story also as I go ahead. This section says, if you are the auditor of any company, and in the course of audit, if you have detected a fraud, then if the value of the fraud is more than 1 crore rupees or more, you have to immediately inform the central government about the fraud within 60 days of you detecting the fraud, without waiting for you to submit the prepare the whole report within 60 days. And you have to inform the government, and by using a form called ADT4. They said that's a section. If the value of the fraud is less than 1 crore, then you have to inform the board of directors about the fraud. And the board of directors are supposed to carry the details of the fraud in the director's report. So that is the 143 subsection 12. But this section also has one more huge thing. Please note, this section talks about a penal consequence, 143 subsection 15. The penal consequence is, if you don't do this, then it will be punishable fine which shall not be less than 1 lakh rupees, but which may extend to 25 lakh rupees. Please note, don't comply with this fraud reporting. The fine could be, which need not be less than 1 lakh, but which can be up till 25 lakhs. Please note the number, the huge amount of, and please note, this is one section, section 143 subsection 12 of the Companies Act, which is applicable for the financial auditors like us, for cost auditors, and also for secretarial auditors. So even they are all subject to this kind of fines. So please see, if you don't report a fraud, you have to be imposed with this kind of fine. I will quote the former secretary of the Ministry of Corporate Affairs. He's no longer, he's retired now, but his comment was carried in the newspaper. So I have no hesitation in carrying his comments, in stating his comments. We were sitting to prepare the guide, to prepare the new CARO. I was part of the committee also, representing the Institute of Chartered Accountants of India, on preparing this CARO 2020. Right, and as and when Visakhapatnam branch organizes a program on CARO 2020, I'll be very happy to come and share my thoughts, because many of these clauses, we were discussing and I was present, part of the committee. Anyway, that's separate. So, this then Secretary MC, I would not like to name him, he said that, look, fraud, if it is a needle in a haystack, I repeat the words, if it's a needle in a haystack and the auditor could not find it, I have no problem. But if the fraud is like a rogue elephant running amok in the premises of the company and the auditor still does not report it, then he said, I have great problems. As soon as he said this, I raised my hand. I said that, sir, you have ADT4, which allows an auditor to report on the frauds. You have ADT4. So he said, how many auditors have used ADT4 to report to me frauds exceeding 1 crore rupees? And then he said, can we change the CARO this time? In CARO 2020, can we make an insertion to say that every auditor will have to report in CARO 2020 whether ADT4, which is the form for reporting fraud exceeding 1 crore, whether the ADT4 has been used by the auditor during the year. How could one object? Once he said that, we agreed. And please note, in this CARO 2020, this aspect of ADT4 is very much embedded in CARO 2020. I've told you about 143 subsection 12. Now, let me tell you a story. Again, all these are experiences, but which you'll find interesting and which you will find, very, very this thing. Two examples I'll give you. The first example, we are the auditor of a central PSU. This is the case of an auditor of our firm being the auditor, and I was the signing partner. This company was in doldrums, not doing very well. The sales had gone down, and the company is fraud prone. But because there was no vigilance officer as such, we could not get any details about the frauds. So what we did, we sought for a management representation. Please note, a management representation. Here, I will also take you through auditing standards. A management representation from the company, the general manager of finance, he gave us a management representation stating that no fraud was noticed by the management during the year on or by the company. He gave us management representation for that year. And there was a lot of pressure since it was central PSU, a lot of pressure on my part, on the firms, on the firm also to complete the audit. Based on that, and despite my best efforts, I could not find out because the accounts were not maintained. And please note, I was going to give an adverse report on this because the companies, we gave an adverse report on this. Company's state of affairs is pretty poor, but we wanted to give a report on the fraud. Please note, those of us who are the auditors of PSUs, if you don't report on the fraud, the CAG or the AG people, somehow or the other, they have this uncanny ability to find out a fraud. So what was happening, since I was already giving an adverse report in this case? Go management representation and quote that management representation in my CARO report. Section 143, subsection 12, which has been changed now in the Companies Amendment Act 2020, recent changes. I was on the verge of finalizing the report. At that time, I get a call from the managing director. Two stories, and which you'll find very interesting. The managing director, he said that, look, the new managing director, he said that, look, I was in Bombay and now I have been transferred here and I have just joined this company about 5 days back. And he was saying that, Mr. Mitra, I find that this is the audited report is pending and would you kindly issue me the audit report in the next 2 or 3 days? I said that, sir, I have heard you. But sir, I was telling him that, but Mr. whatever it is, Mr. X, but Mr. X, please note, we were delayed in completing the audit. Please note, I had already said in the report, I had finalized the report which said that no fraud on or by the company because of the management representation. I said that we had delayed in the report because we were not in a position to verify the frauds. And now we have got a management representation. So based on that, we are trying to, as soon as I said the fraud, that gentleman from the other side of the phone, he started saying that, Mr. Mitra, what to say? This company is totally fraud prone. I was listening to him on the other side. He said, during this year itself, I have found out that 4 FIRs have been filed with the police station regarding fraud. Please note, I have a management representation from the GM Finance, which says that no fraud has been committed. I heard him out. I told him that I shall release the report in the next 2 days. Can you please share the FIRs with me, please? He said, instantly, I'm going to share. He shared. On that day, God was with me. Please note, the biggest lesson from this is, it's good to have management representation. Management representation is a tool for audit, but not the only tool for audit. Do not rely on management representation blindly. Not correct to rely on if I would have relied on that day, I would have still argued. But let me tell you, CAG would have found out about that fraud. And they would have hauled me up for not having reported that fraud. I would have said that, look, I could not check this. I have given an adverse report, but still I would have been in trouble. So the moral of the story in this case is, do rely on management representation, but do not make it the only tool for audit. So this is 143. Please note, the change has been on the recent change has been on the penalty side, which I'll come to. Because the penalty is 25 lakhs, as I said, the penalty for non-reporting of fraud under section 143 subsection 12 is between 1 lakh to 25 lakhs. This is another story on this penalty. I was speaking at a conference in Odisha about 3 to 4 years back. After I had spoken, and my topic was fraud reporting under the Companies Act. That was my topic, fraud reporting under the Companies Act. After I had finished speaking, a gentleman, a very senior man, along with his son who had just passed out maybe 2 years back, I was having a cup of tea, and both of them, they walked up to me and they said that, Mr. Mitra, Can we just have a few words with you in a separate room? I looked at the gentleman. He looked to be in his late 70s or early 80s. And his son or must be his son or grandson could be about his grandson, most probably about 25, 26 years. I said, certainly, sir, why not? So I sat down. He said that, Mr. Mitra, I'm spending sleepless nights. And after hearing your lecture today, I'm further, see, and at this age, I'm going to have further tension. I said, what is the problem, sir? He said, Mr. Mitra, we are the auditors. We are a very big firm, one of the biggest firms in Odisha. I said, all right, sir. And he said that we are the auditors of a central PSU. And he was naming the PSU, which I don't want to name. And mind you, since both the examples are relating to PSU and fraud, it does not mean that all PSUs are fraud prone. There are excellent PSUs that we tell you, excellent PSUs. PSUs done very, very well. But just that, you know, I'm giving you two examples where both the examples are relating to PSUs. So you see, he was saying that in this case, there's a fraud of about 2.6 crores. But he said, Mr. Mitra, because of pressure from the various quarters, I have not reported that fraud to the central government by using that ADT4. And he told me, Mr. Mitra, I have also heard earlier that non-compliance is the penalty could be as high as 25 lakhs. And today also I heard you say the same thing. He was telling me in the lecture. And he's telling me, Mr. Mitra, I'm quite upset, frightened. I really don't know what is going to happen. I heard him out. And he was, you see, very, very angry with his grandson. Right. So I said that, sir, if I may ask you a few questions. He said, all right, Mr. Mitra, please do so. I said that, sir, who detected this fraud? He said that the company detected this fraud. And this fraud, after having been detected by the company itself had filed a FIR with the police station. He said that we did not detect this fraud, Mr. Mitra. The company detected it themselves. And that's why the company said, since we have done everything, we have detected, we have also informed our nodal ministry, why do you want to again report this fraud as part of section 143.12 by using ADT4? I said that, sir, I have some good news for you. He said, tell me. I said that, sir, I think tonight you will have a peaceful sleep. He said that, why do you say this? Tell me. I said that, sir, there is in 2015, the Institute of Chartered Accountants of India has issued a guidance note on section 143, subsection 12. And the guidance note stated that if the fraud has been detected by the company and not by the auditor, since the detection has been done by the company and the company itself has reported itself, then the auditor does not have a responsibility to report that to the central government using ADT4. He said that, is there a guidance note like this? I said, 100%. I told his grandson that you have a look. He immediately saw that guidance note. Right? But then I said that, sir, I have only given you part relief. I don't know whether I can give you full relief or not. He said, what will make you give me full relief? I said that, sir, in the Caro report, did you report on that fraud noticed by the management during the year or by the company? He said, yes. I have reported that in the Caro report. Caro report, I have reported that fraud. But I did not report in the main report under section 143.12. I said, then, sir, full peaceful sleep for you. Because you have complied. Till today, he must be about 85, 86. I get his Diwali greetings and I get a phone call from him. Right? And he says that, you see, that day, whatever you did, the kind of this thing that relief that you provided, I did not provide any relief. What was the relief what did I do? I was just aware of that guidance note, existence of that guidance note. So to all of you who are listening to me, you see, if you go through the institute's pronouncements, institute's guidance, they act as a protective shield for you. Those of us who are hearing me and heard the speaker before me and heard the speakers yesterday, please note, it's only not for your CPRs. These kind of lectures could be your protective shield. But please, again, going back to the point that I said, what's the change that has been brought about in the Companies Amendment Act 2020? Please note, the penalty was from 1 lakh to 25 lakhs, and we felt that that penalty was highly unreasonable. Highly unreasonable. Now, in the Companies Amendment Act 2020, which has got the assent of the President on the 26th of September 2020, the penalty is, in the case of a listed company, the penalty is 5 lakhs, up to 5 lakhs. And in the case of any other company, the unlisted company, it will be only 1 lakh rupees penalty. Please note, the earlier penalty was 1 lakh to 25 lakhs. Now it has been reduced to only 1 lakh in the case of a non-listed company. In the case of a listed company, it's 5 lakh rupees. So that is the big change, big relief that has been there under Section 143, subsection 12 of the Companies Act. So, as I said, I think I have only about 5 minutes left or 7 minutes left for me to finish. At this 6 or 7 minutes, I'll take questions. But the moral of the story is, study all these guidance notes, attend all these beautiful programs organized by Visakhapatnam and all the other branches. And I'm sure it will help you, in your profession. With these words, I thank all of you for a very patient hearing, and I am now open to questions. Madam, if there be any questions, I'll be very happy to take them.
Members are requested to unmute themselves and ask if there are any questions.
You stop,
Right.
Madam.
Some questions have come to me. Yes, tell me. Get in the chat box, which I'll also take. Should I take those in the chat box at first, Madam? I will take those in the chat box at first.
Yes, sir.
Yeah, good. All right. Sir, we are using standalone FS in case if you require to prepare consolidated FS. Please do confirm. Certainly, yes. If you are preparing CFS and the mother standard for CFS, I'm talking about AS, is AS21. That is the mother standard for CFS. And if you are preparing a CFS, then you please use the word standalone. Then Mr. G. Vasudevan Murthy asked, what's the difference between key area issues and emphasis of matter? You see, both of them are important, but key audit matters are a bit higher than emphasis of matter. For example, this COVID time, many of us, we did the audit offline and online and things like this. So we use the key audit matters. The degree is a bit higher, but please note, if you want to know greater than this, then you may please go for the implementation guide on key audit matters, SS 701, issued by.
Not allowed to open it. Audio, video.
You may also go for the implementation guide on SS 706. Right. If there be any other questions, I will also take them. One good thing is, when I started off, there must have been about 76, 77 participants. I find about 73 still there. So that's fantastic. So congratulations to all of you, because I believe that all of you have been here to to learn new things about auditing standards, about Companies Act, etc. So, Madam, if there be no questions, I think we can call it a day.
Thank you so much, sir. So actually, through your anecdotes and storytelling, you made the session very informative and interesting. So all our questions were answered only through your stories.
Can you hear me, Madam? Yes, thank you.
So you cleared a lot of our queries on simple terminologies and basics that we might go wrong in, be it the standalone definition or small company, or be it on the standards on auditing of SA 700, 705, 706. And it is to mention, like they say, straight from the horse's mouth. We have none better than the vice chairman of the Auditing and Assurance Standard Board answered our question. So thank you for that, sir, on highlighting on about, and we have to mention that when we had these sessions on auditing and assurance revisions and highlight, there was this mention of SA 3400 on projections and forecasts that you really emphasize today. SA 800, then all the sections that you highlighted for us on the updates of the Companies Amendment Act, 135.5, 129 capital A, 143, or if you call it the decriminalization of offenses, 143.12, fraud reporting. So all these sections most relevant for us, you have highlighted. And thank you so much, sir, for taking your time and being with us and updating us on the latest updates. Thank you for your presence, sir.
Thank you very much, and all the very best to all the branches who are present here. Thank you.
Thank you so much, sir. So I would like to make a mention to all the members present here about the closing of the technical session of day 2. And as we propose the close of this entire session, may I please remind you to please log in at 10 a.m. tomorrow. The time is from 10 a.m. to 1 a.m. tomorrow. And the topics that we have are value addition through internal audit, effective internal audit mechanism, accounting standards 15 and 22 from CA Amit Gupta, CA Ankur Gupta, and CA Vijay Kumar, MP, Chennai. Thank you so much for all the audience present here. And I hope the informative sessions do help you in your audits that are coming up. Thank you so much. We propose to close the day.
Thank you, sir. Thank you. Thank you all. Tomorrow at sharp 10 a.m., sir, we'll be gathering as the examinations are going to start from tomorrow afternoon. So we have preponed the timing of the conference. It was planned before only, sir, as the exams have been started. So it's just a note that tomorrow session is from 10 a.m. to 1 p.m. Thank you.
Thank you so much, ma'am.